GM. This lesson is tokenomics. It's going to be a 3-part series where I'll talk about tokenomics, what they are, why they matter, and how to analyze them for yourself as a trader. So, if you don't understand, tokenomics relates to the supply of tokens. So, every coin you see in the market has a different total supply and a different circulating supply. Obviously, Bitcoin was the first crypto, and it was a proof of work. So it was launched and it is emitted through mining, and it had a max supply, or has a total max supply of 21 million. Every coin that's came after that has some type of variation on that, and with the explosion and the growth of crypto, it's attracted more and more institutional capital, VC, so venture capitalists, early investors, basically people who try to buy into projects early, whether they get allocation and they invest in a project before it launches, or they try and invest into things whenever they are relatively new, hoping that if they're correct and the project grows, they will realize a return on their investment. That's the most important thing to remember and to say at the very start. Everybody is here for the same reason: to get rich, or to get richer, or to increase their net worth. There is nobody in this market that's doing it for charity. Just like you want to make money trading or investing or buying and holding or whatever you're doing, farming airdrops or staking, or everything is done with an incentive of, I want to own this thing because I think it will go up in the future and I can sell it for more. The very same thing applies to not just the investors in these projects, but the teams, which is underlooked, right? These are, especially in the good projects, like these are world-class developers building real technology, but for doing so, they do deserve a reward. And so a lot of them get rewarded through allocation of tokens. They might have a salary, but many of the, especially the leadership or the head, the core devs of any of these teams, they'll have some kind of allocation where they own a portion of the supply, and then they can obviously realize that into profits at a certain point in the future. So in this first lesson, the first part, we're going to help you understand total supply and circulating supply. So when you use a website like CoinGecko or CoinMarketCap, you'll generally see a few different things. Market cap is the market capitalization. That's the the token price multiplied by the number of tokens that are currently in circulation. So you can see it on the screen for Chainlink. The market cap is just over 11 billion. The way you find that 11 billion is you go to the circulating supply, 587 million, and you multiply that by 1897, so the current price. That tells you what the market cap is. So obviously, as price fluctuates, so does the market cap. But it's not just price fluctuating that affects the market cap. Remember, it's token price multiplied by number of tokens that are in circulation. So if you increase the number of tokens that are in circulation and the price stays the same, the market cap will rise. And generally, with all else being equal, every market operates on what? Law number 1, which is supply and demand. Supply and demand underpins basically all economic activity, and the prices of everything are dictated by that function. How much demand is there for the product or service or token, and how much of a supply is there of that product or service or token? So there's a few things you want to look at when you're looking at these projects. You want to see how many tokens are currently circulating and what is the total supply or the maximum supply of all tokens that will one day be in circulation. The second part of that, which is the fully diluted valuation, FDV, you'll hear about this a lot, you'll see it a lot. The FDV is the token price times the max number of tokens that will ever exist. So the total supply for Chainlink, once all the tokens are released, will be 1 billion. So you multiply that by 18.97 and you get 18.9 billion as an FDV, fully diluted valuation. So when you're looking at that, there's a few things. Every project launches differently, so you need to start to understand what the different tokenomics look like, what each project is doing, and you can't just compare them apples to apples. You can take two coins, right? Let's say you're looking at AI and you're looking at render and fetch, two popular AI coins. And you look at then the price. You can't just look at the price of render and the price of fetch. If render is $5 and fetch is $1, that doesn't mean that fetch is 5 times cheaper than render or that render is 5 times more expensive. It matters how many tokens render has circulating and how many it can have in total, and the same for fetch. That's the same reason why Bitcoin can be $52,000 and SHIB can be 0.0000003 fucking cents. It doesn't mean that SHIB is so much cheaper than Bitcoin. They have different distribution schedules and different supply dynamics, right? Now, if you increase demand and supply stays the same, what happens? Price will go up. More demand for the same amount of any product or good or service or token will increase the price. But the same happens on the other side. If you increase the supply, but the demand stays the same, the price will not increase. It will stay the same at best, or it will even drop. And that's where a lot of these projects, where they have a lot of tokens that are still to come, they have a lot of tokens that are not yet emitted, the price they're at currently, they're going to need increased demand in future for price to keep going up, because there's going to be so many more tokens entering the market. There's many reasons why teams do this, right? So some of them, you'll hear things like, you can say low float is a term you want to keep in the front of your mind. Low float means whenever a project launches, if they launch with a really small percentage of their total supply, which is very common now, you see this on many projects, where they might have 1 billion tokens in total, but on day one at the TGE, token generation event, they might only launch with 10 or 15% of supply, right? So 85 or 90% of it is still locked up. That's low float. So they do that for many reasons. One, it's easier to pump the coin, and that is a big factor, right? Remember what I said at the start, everyone's here to make money. If you launch with a smaller supply, it takes less demand to increase the price. Because even if you can have 1 billion tokens in total, if you only launch with 100 million, it's only those 100 million that can affect the supply and demand and can actually affect the price in the short term, right? Until those new tokens are released, it's just the tokens that are there that matters. So if it's easier to pump, it's easier to make the price go up. And if the price goes up, people want to buy it. And if the price keeps going up, people want to buy it more. And that's how bull markets in particular work, because of reflexivity. When prices go up, we expect them to keep going up. And if you've seen this, if you've been in the market for more than 2 weeks, you'll understand that people talk good about projects when the price is going up. Exact same project, but if it pumps 50%, suddenly everything looks better. Suddenly, it's got great fundamentals. Suddenly, it's the future of finance. So teams know this, investors know this. And if they're able to launch with a low float, pump the price up to a high level, then it can generate more interest, and sometimes it can even be a self-fulfilling prophecy, meaning if it can go high enough, it can actually get adoption. People might say, well, let's use this thing. People might actually start to put more value on it. And people might end up saying, no, this is actually a good project. And because the price was going up, more people use the chain. And then, Solana, for example, which had really high inflation in 2020 and 2021. But because it was pumping and because people were using it, and then devs started to build on it, it actually developed a real community, a real ecosystem, and is now, infinitely more valuable than it was just 3 years ago. Another reason for that is to anchor higher prices. So projects will launch with a low float because it's easier to pump. And if you pump to a certain price, as traders and investors, what do? We always anchor the price of a project based on its previous all-time high. Because if you saw a coin that launched, right, it launched at $1 and it went to $10 and then it dropped to $4, people will look at that and say, oh, look, if I buy at $4 and it goes to $10 to all-time high, that's a 2.5x, and they start to calculate trade returns in their head. So pumping it as high as possible is a strategy that almost any project will try to do, because with that anchoring effect, traders and investors will want to buy as long as it's below the all-time high, and if it goes above the all-time high, they're expected to go even higher because it's crypto and stuff can go up in parabolic uptrends. And it also helps the investors to lock in their returns. This will come in one of the later lessons on tokenomics, but many of these early investors get their tokens for fractions of what you get them at in the open market. A coin might launch at $1 token price, but they might have invested in the project 2 or 3 years before that, and their token price was 20 cents. So even on day one launch, they're at a 5x profit. But almost every project launches with a lockup, so they don't allow the early investors to just dump their tokens on day one. Most of the time, the most common one is 12 months, where on day one, the investors don't get anything, but 12 months after the launch, they start to get their tokens. So again, the game is about how high can we keep the price, how high can we get it to go, so that even if it goes up and down and is lower in 12 months from now, if it's still above our 20-cent buy-in, we're in profit and we can turn that and realize it into a return, which is what they're